Hi friends, welcome back to Murthy Finance Academy. Today, the third company which we are going to discuss from wires and cables is none other than RR Cable. So previously, I already made videos on Polycab and KA Industries. If you haven't watched that videos, please do watch them, which are already live on the channel. So now let us start. Before we proceed, a quick disclaimer. I'm not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. So RR Cable has solidified its position as a quintessential proxy play on the Indian infrastructure and residential real estate narrative. Far from being a commodity vendor, the company operates at the critical intersection of urban development and mandatory electrification standards. Its strategic importance lies in its ability capture value across the building materials ecosystem, translating macroeconomic tailwinds such as the structural shift toward branded, compliant electrical solutions into a scalable, institutional grade business model. So, the company primarily operates through two distinct segments. One, wires and cables, the core engine encompassing housewares, industrial cables, power cables, and specialized communication or solar wires. Second is FMEG, fast moving electrical goods, a strategic pivot into consumer durables, including fans, lighting, switches, and appliances. So, for 9 months fiscal year 2026, the revenue mix stood at 74% wires and cables and 26% from FMEG. This concentration defines a risk profile heavily tethered to industrial and construction cycles, while the wires and cable segment provides a high volume foundation with a significant operating leverage. It exposes the P&L to commodity price volatility. However, the FMEG segment represents a long term premiumization play aimed at diversifying into household brand equity. This internal structural shift is currently the primary determinant of the company's margin trajectory. So, the Indian cables and wire sector is currently navigating a Goldilocks phase, characterized by the simultaneous peaking of residential real estate upcycle and massive government infrastructure outlays. This environment is further bolstered by structural migration from unorganized to organized players, driven by stricter safety regulations and the branded preference of modern consumers. So, management identifies a sustained demand floor created by housing modernization and grid electrification. While the industry is projected to maintain a 15% CAGR, roughly two times of India's GDP growth, RR Cable is aggressively positioning itself to gain market share. Management has guided for a 17 to 18% annual volume growth run rate, an ambition that was notably exceeded in Q3 with a 30% volume expansion. This outperformance suggests that RR Cable's distribution depth is successfully displacing unorganized competitors even during periods of price volatility. So, if you see a granular segment analysis is essential to decouple the robust cash flow of the core business from the gestation period losses of the FMEG pivot. The wires and cable segment delivered a massive 48.6% year-on-year revenue surge to 2,293 crores in Q3 fiscal year 2026, underpinned by 30% volume growth. While domestic demand remains the bedrock, export business grew by 25%. Crucially, RR Cable employs 100% back-to-back booking mechanisms for exports, insulating the P&L from international metal price swings and ensuring margin predictability in a volatile environment. Coming to FMEG segment, it reported steady revenues of 243 crores. While demand in discretionary categories remains selective, the qualitative improvement is evident. 20% of FMEG revenue now originates from premium and mid-premium categories. Management has utilized channel level adjustments to rationalize the portfolio, prioritizing margin protection over raw volume growth in a sluggish consumer market. So, wires and cable segment maintained a margin of 8.7% and 48.6% revenue growth for Q3 fiscal 2026, while FMEG reported minus 2% segment margin with 1.5% year-on-year growth, but its profit before tax and interest reported a loss of 4.9 crores. So RR Cable achieved its highest ever 9-month revenue and PAT in fiscal 2026, signaling that the company is successfully scaling its operating model without diluting execution quality. So Q3 revenue reached 2,536 crores, with an EBITDA of 206 crores. However, the reported PAT of 118.2 crores was supposed by a non-recurring exceptional item of 19 crores due to the new labor code. Normalized PAT would have been 137.2 crores, reflecting the true underlying earnings power of the business. So for fiscal year 2025, the CFO to EBITDA ratio stood at 1.01 times, an excellent indicator that earnings are fully backed by cash. And coming to working capital, the 9-month cycle remains disciplined at 56 days, while payable days increase it to 42. So this appears to be strategic optimization of supplier credit to manage liquidity during a period of 25% copper price inflation. So RR Kabel is demonstrating a significant expanded operating leverage, hitting record sales even while managing a major labor related provision. The underlying business is actually stronger than the final profit number, such as once you add back the one time 19 crore charge. Crucially, every rupee of profit is backed by real cash in the bank, proving high earnings quality. So, if you see, the operational metrics validate the execution of Project Rise, specifically regarding capacity absorption and supply chain discipline. So, capacity utilization, wires are currently at 70%, while cables have hit 90%, necessitating the ongoing expansion. If you see inventory also, inventory days rose from 56 in March 2025 to 62 in December 2025. While this indicates a slight build-up, it serves as a necessary buffer against the 20 to 25% copper volatility witnessed during the quarter, preventing high cost stockouts. And coming to asset turnover and capex, the company deployed 280 crores in capex over 9 months fiscal 2026, part of larger 1200 crores roadmap. With cable utilization at 90%, this investment is critical for maintaining the 18% volume growth run rate. In a commodity heavy business, management's ability to implement a pass through mechanism is the ultimate litmus test for brand power. So, company's MD Mahendra Kumar Kabra and COO Rajesh Jain have reiterated a goal of 100 basis points annual margin expansion, targeting 10.5% EBIT margins in wires and cables by fiscal year 2028. In Q3, they delivered an 8.1% EBITDA margin, a substantial step up from 6.2% year on year. They successfully navigated a 20 to 25% surge in copper prices by implementing frequent discipline-led price hikes, often multiple times within a single month. So management has not only met but exceeded volume guidance. So 30% versus 18% target. Their ability to maintain 8% plus margins despite the metal price surge validates the brand's pricing power. So the leadership team is successfully executing its project price strategy. They proved that RR Cable is a price maker, not a price taker. By passing on massive copper prices push the market without hurting sales volumes. This is a clear signal of high brand strength and management competence. So coming to key metrics, so the company currently trading at a PE of nearly 36 times with a dividend yield of 0.4. So even the ROE also, if you see, it is standing at nearly 15%, which is a notable drop from the 21.5% which we have seen in fiscal year 2024. The 36 times PE is rich but justified by the 18% volume growth trajectory. The drop in ROE is primarily a function of an expanded equity base following the IPO and the heavy reinvestment cycle of 1200 crore capex. As these new capacities yield full results, we expect ROE to mean revert toward historical highs. So the company's key red flags are commodity affordability ceiling. While pass-through though has worked, a further 20% surge in copper could hit the affordability ceiling for retail consumers, slowing secondary demand. And dealer working capital stress. Rapid price hikes strain dealer liquidity. If dealers cannot finance higher value inventory, it could trigger tactical destocking. And B2B underpenetration. Management admits their B2B mix is currently below the industry average. While this represents a strategic catch up opportunity, it currently leaves them more dependent on the fragmented B2C channel. And selective FMEG recovery. Fans and appliances continue to see uneven demand, which could delay the segment's full year EBIT breakeven. So, coming to strengths, export risk mitigation 100% back to back booking eliminates price risk for international orders and superior volume growth. 30% volume expansion significantly outpaces the 15% industry average. Coming to weaknesses, FMEG drag segment remain in loss territory despite premiumization efforts, and ROE compression. Currently at 15.2%, ROE is well below the 21.5% historical peak due to equity expansion. Coming to opportunities, EU trade deal, which 3.7% duty reduction is a massive tailwind given 40% of exports are EU bound. And B2B catch up. Expansion into power cables offers a large white space currently dominated by peers. And threats coming to threats are copper volatility. Sharp 25% price swings can compress dealer margins and liquidity. And selective demand. Consumer confidence in discretionary FMEG categories remains fragile and uneven. So, what are the some key monitorables are copper pass-through efficiency, second is FMEG break-even, and third is capex deployment, and fourth is volume run rate, and fifth is inventory days, and sixth is export mix, seventh is South India penetration, and eighth is B2B progress. Ninth to track is EU treaty implementation, and 10th is staff cost efficiency. So, as a final summary, RR Cables Q3 fiscal year 2026 performance is an exhibit in operational resilience. The company's ability to deliver record revenue and an 80% surge in EBITDA despite a 25% spike in copper prices demonstrates a robust brand-led pricing model. The volume outperformance suggests that RR Cable is the primary beneficiary of the industry's consolidation towards organized players. Project Rise strategy is at critical juncture. While the core wires and cable segment is generating the cash flow necessary to fund growth, the FMEG segments move toward premiumization and its imminent break-even are essential for a valuation re-rating. The potential 3.7% duty reduction in the EU, a market representing 40% of their exports, provides a significant margin tailwind that the market may not have fully priced in. From a portfolio perspective, RR Cable remains a high conviction play on India's secular electrification trend. Where 36 times PE reflects high expectations, the company's excellent earnings quality and disciplined working capital management provide a necessary safety margin. The key for investors will be monitoring the transition of heavy capex into yielding generating assets and the successful turnaround of the FMEG division. Hope you like this video. If you like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.